So I think that some of you probably heard me speak before at Pocket Gamer. It's great to see it become so big. So I think we all really owe Chris huge thanks, particularly for making the conference here in London, putting kind of UK on the map. And what I found really particularly interesting this year, and I think Chris mentioned it to me, was that there's 1,700 people coming here. And what's actually more interesting is from over 50 countries. So I think that actually dovetails nicely into this presentation, because most of the transactions in our industry are global in nature and are cross-border in nature. So first, just a couple of points on Agnitio Capital. We were probably one of the longest standing, if not the oldest, European investment bank focused on games. We were founded in 2003. We're fully authorized and regulated by the Financial Conduct Authority here in the UK. That's kind of the equivalent of the SEC in the US. We're headquartered here in London, but we actually recently opened an office in Seattle in the US, which is run by my business partner, David Bloom, which many of you might know. He's been an industry veteran for many years. He's successfully started and sold a number of games studios in the past. As mentioned, we're kind of exclusively focused on the game sector, primarily mobile, but also online. Again, since we're an investment bank, and again, I guess I don't want to be very vague about exactly what our principal activities are. We are an advisor first and foremost. So I'll go through some of the recent transactions and again, why I've decided to focus on M&A rather than fundraising as I've done in the past. So very recently, literally just a few weeks ago, we advised a company called Babel Games on the sale of that business to Stillfront Group. If you're not familiar, Babel Games is the leading Middle East, North Africa focused mobile game publisher. And Stillfront is a publicly listed, diversified online and mobile gaming developer and publisher listed in Sweden. And shortly prior to that, in October, we advised a very successful studio based in the US out of Madison, Wisconsin, called Pear Blue, on the sale of its most successful IP, Dragon Soul, which many of you might have played. It's an action RPG. At the time of the sale, it was about a top 40 grossing overall app in the US charts, and about a top 100 to top 150 on iOS, so quite successful, and in fact had even better chart position in other countries. And we sold that to Gree, which is one of the largest publicly listed mobile gaming developers in Japan and frankly worldwide. And prior to that, last summer, we sold Tickbits Oy, which is a Finnish-based pure play mobile gaming developer, original IP developer, to a company called Animoca Brands, which is based in Hong Kong, but actually listed in Australia. I think Robbie Young, who's sitting in the back there, is going to speak more about that transaction a little bit later. And we also actually do make investments very, very selectively. That's David and myself. Where we will actually lead sort of more angel rounds or syndicates. Some of those investments include Hutch Games, which you might be familiar with here in the UK, developers of MMX Hill Climb, Social Spiel, which is a Nexon investee company, which is about to release a very interesting title, and Gungeon Games, which is based in Brighton. So I think everybody in this room is probably aware of how prolific 2016 was in terms of M&A. Absolutely phenomenal in terms of just sheer numbers when you compare it to historical kind of averages of M&A. And I think there's probably some points prior to that which could set the scene as to why 2016 was so prolific. I think everybody's aware of just how dominant the larger players are continuing to become. And previously, everybody would talk about cracking or trying to make an attempt to get into the top 100. Well, actually, that's really kind of more sort of top 200 or top 300 if you think about it now. And a lot of that is driven just behind the sheer amount of resource they have, not only in terms of marketing spend, UA capabilities, cross-promotional capabilities. So that's just leading to them having more and more multiple titles, not even in the top 100, top 200, and top 300. I think Keith alluded to it previously, CPI costs, particularly when you're looking to market a much more hardcore, complex game, continuing to increase. A lot of that, again, is possible by, I guess, or in some ways, forced by larger players who want to just crowd out the market, who've actually managed to increase the LTVs of their games. So, which leads to then acquiring users profitably to be very, very challenging. And costs of development are actually going up if you want to compete with these larger players significantly, since the AAA quality and polish of those games that they're releasing are just continuing to increase. And another really important point that I think a lot of us may not be aware of, but certainly will be, is the mobile gaming part of the entire games industry. The mobile gaming sector itself is actually the largest component. So that's larger than console now and larger than PC Online. Which leads to 2016. So I think if you go back starting from 2010 up until about 2013, you'll see the historical average for the completed deals, let's say M&A deals, announced deals that we actually were disclosed, the deal values, kind of being around the $4 to $5 billion mark. And then in 2014, you had a pretty phenomenal year, which was the record-setting year in that year of about $12.5 billion. And then last year actually went down significantly, but actually probably fairly in line with typical historical averages. And then when you compare that to last year, what's just absolutely amazing is it's almost double of the previous record-setting year of 12.5 and came in at 24.1. But I think it's also noteworthy to talk about the mega deals that occurred last year that I think we're all aware of. Everybody remembers Tencent and Supercell at $8.6 billion, Activision and King at $5.9 billion, the consortium led by Giant, which acquired Playtika for $4.4 billion, and again another consortium led by a private equity fund from China, Orient Hante Capital, that acquired AppLovin for $1.4 billion. If you add all that up, just those four deals, which equals slightly higher than $20 billion, that's more than 80% of the entire 2016 market, just four deals. Now that's completely unprecedented, never happened before in our industry. So kind of leads to a lot of points that I'll go through a little bit later. So really what I think of 2016, yes, it was a record-breaking year, but what I think of it is certainly it's the year of the mega deal. So the market was super active for really dominant large players. And if you think about it, the two largest players in the mobile free-to-play space were acquired last year by revenue: Supercell and King. And if you strip those out, you kind of get back to historical averages. So what really contributed to those 2016 results? So I talked previously a little bit about the trends leading up to it, but actually you have now quite an interesting dynamic, rapidly evolving industry. So console giants who completely missed mobile, I think Activision being one of them, had to, from a really defensive point of view, acquire King. They really had no choice and really had no mobile play, and kind of the writing was on the wall. As I mentioned previously, mobile has become the single largest part of the entire game space. And then, of course, you have geographic expansion. So a lot of Asian publishers that I'm sure many of us are familiar with are continuing to purchase and acquire U.S. and European leading players. Tencent, Supercell being the largest transaction, but there was obviously the Playtika deal and the AppLovin deal and a number of smaller PC deals as well. You also had non-games industry players moving into the game space. And again, as I mentioned, these were some of the Chinese consortiums that led the transaction into Playtika. And also you had some consortiums, non-games, that actually acquired Jagex here in the UK, that acquired Big Point in Germany, and Splash Damage here in the UK as well. Most of those mega deals that I alluded to were of mobile free-to-play studios, the exception being AppLovin, and then I think I mentioned already that there were a few PC M&A deals. So what are acquirers paying for these businesses? Well, it's fairly easy, and at least, well, I mean, let me take a step back. There's a lot of M&A deal activity and a lot of number of deals that we tracked that actually contributed to that $24.1 billion figure that I mentioned in 2016. However, there's not a lot of data available for a lot of those smaller to mid-sized deals. So in some cases, we might be able to glean through press releases, whatnot. We might be able to find what a revenue multiple was or an EBITDA multiple. But at least from a large mega deal perspective, we do have the multiples. We do know what we're paid. And the average is really kind of, if you're looking at it from a latest 12 months of revenue of the target company, so this would be Supercell, this would be King, you're looking at around 3 to 4 times sales and paid in cash up front. And on an EBITDA basis, you're looking at really just over 10. I didn't want to list out all the small to mid-size because there's just frankly too many. We would go on for pages. So I've just provided the summary here. What is interesting to note is if you look at the maximum and minimum and average ranges, you have a lot more discrepancy than you did in the previous slide of kind of 4.1 to 6. If you look at the average to the maximum and the minimum to the maximum, and then here, if you look at the minimum to the maximum, you're looking at 0.3 sales multiple up to as high as 7.6. So you really have this profound range. And I'll talk about that a little bit further, but there's a lot of characteristics contributing to why an acquirer would pay 0.3 times sales or 7.6. But the averages came in at about 1.9, so just under 2 times sales without an earnout. Now, I think also a lot of you are aware, for the smaller the company you have, the more risk an acquirer is going to take to buy your company. So one way to offset that risk and ensure you continue to operate and hit your numbers and agree to performance targets that they'll obviously ascribe to your business going forward is they'll arrange or kind of structure an earnout for you. So 2 to 3 years usually is the kind of standard earnout structure for a lot of smaller to mid-sized deals that are being negotiated in our industry. And with those, assuming you could hit those earnouts, then the sales multiple actually gets to 3.2 and fairly similar to what the large players are getting. So do bear in mind, though, that a lot of these companies, and in fact, some of the transactions we structured last year are very typical of that. The companies we advised, they'll get a certain amount of cash or shares up front as consideration, and based upon their revenue and profit performance over the next couple of years, they'll get additional cash and shares. So I think, again, if you're a smaller player, it really depends, what you're looking for, and the acquirer you're discussing with to negotiate the kinds of multiples that would be attractive to you and be attractive to them. So again, I'm not going to get too much into negotiating. I want to focus more on just kind of strict data in this presentation, but if you have additional questions, you want to talk more about what it takes to actually position and exit your, or position your company for an exit, happy to chat about that later. But again, the larger players will always generally receive higher multiples and receive those in cash. And I think I've already described some of the previous, that last point there. And so what contributes to that, again, wide range of multiples, at least for the smaller to mid-sized players? I guess it's a lot of characteristics that acquirers are looking for. Some of these points I think I already touched on, but team is probably one of the most important, is what kind of track record does your team have? What types of games have they done in the past? How has that core team evolved? Have they been working together for a multiple number of years? Have they sold businesses previously in the game space? How long have they been in the industry? How well do they know the acquirers? Do they speak at conferences? All of these things really contribute to decreasing the amount of risk that an acquirer is going to really take on and ultimately pay to you for your studio. Of course, being profitable will help immensely, especially if you're looking to get sold as we are in a very mature industry now. But again, that's not necessarily that important, especially when it comes to other factors for some of these acquirers. And I mentioned even at the beginning of the presentation that a lot of the transactions in our space are cross-border, are global in nature. So geographic expansion is really quite an important point for a lot of acquirers. And again, also acquiring very specific skill sets. Could be UA expertise that they might be lacking, could be development capabilities, AAA, for instance, polish or production capabilities, could be live ops, running live ops, which is, again, increasingly becoming more and more important. And ultimately, I think, really, and what really contributed to those mega deals was market share. So larger and larger players are really trying to battle for an ever decreasing amount of market share, even though if you look at the absolute numbers of mobile, they continue to grow. But it's being concentrated in fewer and fewer hands. So that's what leads to this land grab. And that's why we think that the dominant players will actually move even downstream and start acquiring mid-sized players, just because there's frankly not that many large players left, particularly in the mobile free-to-play space. The two largest players were acquired last year. So other sort of mid-sized players are going to become more and more attractive. In fact, at the end of last year, which the actual deal value wasn't officially announced, but Netmarble acquired Kabam's largest studio, which the Vancouver studio, which actually makes up about 85, actually more, not about 90% of their revenue. Which really leads to, at least if you're kind of an established, whether you're small, mid, large player, if you're as long as you're established, it really, you're kind of in this situation and where we are in terms of the frenzy of M&A activity is you're either going to be an acquirer and be the aggressor and go out and either raise money or you have profits from which to actually go out and make acquisitions. You have the requisite M&A capabilities and can conduct those transactions, or you position yourself and try to acquire and try to make all those characteristics that I described in the previous slide as appealing as possible to a potential acquirer. And if you're not going to acquire, well, then our view is find other like-minded players, merge with them, try to see where you could kind of create vertical or horizontal offering. So if you're only focused on a particular genre or category of games, maybe there's another like-minded studio that has another entirely different category of games, and you ultimately decide, hey, for surviving and we can realize some economies of scale, let's continue to merge and see what we can do. But maintaining the status quo, I think, is going to be difficult. Which leads me to the final slide. So I think some of these predictions, some of you guys are probably familiar with, and wouldn't take too much to really figure out. But Asian players will definitely continue to consolidate. They are very aggressive and are particularly interested from China on acquiring profitable players. U.S. players we think will continue to be absent. I'm talking about companies like EA, Zynga, THQ. We think they'll just probably focus on smaller deals, primarily on the West Coast. Small to mid-sized players, as I think I've alluded to, as long as you can continue to have those characteristics that I mentioned, continue to focus on those types of appealing attributes, you'll be fine. You'll continue to get decent valuations. One area that we think is highly fragmented, which really needs to consolidate, is in the UA marketing services space. And finally, we think that there's, due to the scarcity of large mega deals that are simply available, the 2017 figure is going to be significantly lower than that 24.1 billion figure in 2016. And if Q4 is any sort of indicator for this year, well, Q1 of last year came in at about 7-8 billion. Q2 came in at about 10 billion. Q3 at about 6 billion. and Q4 was only $500 million in deal value. So yeah, that's it. Thank you. Time for questions? Questions? Up. Yep.
Can you hear me?
Yeah.
Banjira
Sure.
from S&P Global. You mentioned there being a lack of large independent players. Who are the large remaining players in the market?
Who are the large players?
Are there any left? Who are the independent
Well, I mean,
players?
there certainly are some, and I think I mentioned there's kind of more mid-sized players. So mid-sized players would be, Scopely, companies like that, that are kind of good game, here in Europe. Companies like that are kind of in the sort of $200 to billion sort of enterprise value range. These are the types of studios that are remaining. The sort of mega deals that I was alluding to, those kinds of companies, Supercell, King, even now Kabam is effectively gone. Those large behemoths, certainly in the Western markets, are just becoming scarcer and scarcer to acquire.
Thank you.
Sure.
We'll take one more question.
Yeah, sure.
I'm thinking about the reverse. Do you see a case where you'll have the mobile companies actually going out there looking for console PC players that are not in mobile but have successfully established themselves in PC and console?
That's a good question. I've thought about this in the past, actually. I've approached large mobile players in the past, and from a buy-side perspective, to say, hey, you're in this really challenging, super difficult market, and these are just some of the largest players that I mentioned, and said, it might really behoove you to probably diversify your portfolio and think about moving to PC online, console. I think they're just so wrapped up in their space, and because it's just so rapidly, literally it changes on a daily basis. I don't see that happening. I think if anything, they're more likely, specifically if they're a larger one, they're more likely to then probably just acquire smaller mobile free-to-play assets. Or what I think you'll see, because, and I mentioned it, the UA marketing services space is highly fragmented. I can see them more likely acquiring companies in that space.